I'm Marella Fernandez. Thanks for joining us today for Market Call. Rebecca Teltscher is on the show today, portfolio manager at Newhaven Asset Management. She's taking your questions today on Canadian dividend stocks. Here's how to reach us. 1-855-326-6266. You can also send an email question in to marketcall@bnnbloomberg.ca. Rebecca, thanks for coming in.
Thanks for having me.
Big day. I'm sure a lot of people are expecting some of the cloud of uncertainty to dissipate a little this afternoon when Washington makes the announcement. Do you expect the same?
It's interesting. I mean, the market's been, if there's one thing the market doesn't like is uncertainty. And we've definitely seen that this year. It's been a bit of a roller coaster. I don't know why the market's up right now. It opened down. I think, market's looking for some clarity, as am I, as is everyone. And, we want to be able to digest the news and then take it from there and see what kind of repercussion it's going to have on the Canadian market and the U.S. market and global markets.
So are you expecting somewhere between the 10 and 20% tariff we've heard sort of bandied about? We're hearing all sorts of different things, right? But 10 to 15 to 20% seems to be the range.
Yeah, probably. I mean, also his administration has said that there's room for negotiation. I mean, we've already seen it before where, tariffs have been stated and then they've been reneged and then they've been postponed. I mean, this would be the third time. So, at the end of the day, I mean, I think we're all tired trying to figure out what the implications are. I think all we can do is our best in trying to formulate a portfolio that's going to be resilient in any kind of tariff situation, whether it's going to be strong tariffs, weak tariffs. And it's not even a question of what the tariffs are. I think the more important question is how long do they remain on before we start to see some more severe impacts.
Okay, so let's talk about what it would look like if we do see a sort of broader tariff, just 10 or 15% across the board, as opposed to individual sectors being targeted. And I'm wondering what sectors do you think will feel it first? We know automotive is one of them.
Automotive, transportation for sure. Consumer discretionary. So again, these are sectors that we didn't really have that much exposure to start with, and not because of tariff reasons, just because we don't necessarily like the discretionary space. We don't like the cyclicality. Our portfolios have always been very defensive, very consistent with regards to our dividend stream. And so as a result, our focuses have always been on utilities, telcos, pipelines, and as it turns out, they're not prone to tariffs right now. So actually, our portfolio has been performing really well, just for no other reason than it's been the flight to safety. And we always like the flight to safety. We always like the characteristics, but now it's obviously more popular than it was last year.
Is that what you would still recommend when people are looking for defensive stocks then?
Yeah, we recommended it even last year when, market was on this huge tear and risk on sentiment with regards to AI, and we were still buying defensive names at cheaper prices. Now, these defensive names are trading a little bit more expensive because the market has seemed to, there's been a flow out of the risky stocks and into the more defensive and out of the U.S. and into areas like Canada. We've always been there. So they're a little bit more expensive than they were, let's just say, a year ago, but we also think that they have good resilience and they could outperform in any kind of market environment, especially as we're going into a period of maybe economic weakness and some more volatility. These are the names that you want to own in any market cycle.
Got it. Okay, we'll talk some more about that as we go through the show. We're going to be back with Rebecca Teltscher, portfolio manager at Newhaven Asset Management. Again, she's taking your questions today on Canadian dividend stocks. Here's how to reach us. We're back in a moment. Welcome back to Market Call, and thanks for joining us on the show today. We're going right to your questions. Kathy has sent in an email from Oakville. She says, I'm interested in CNQ, but when I look at the financials, all I see is red. Please comment as I'm considering a purchase, I guess, at this time. So that's from Kathy in Oakville on CNQ. Rebecca.
Yeah, I mean, you know what? If I could put CNQ as one of my top picks again, I would. I can't because it was my top pick last time I was on in early January.
And you try to mix it up a little bit?
I try to mix it up a little bit, but honestly, I am very convicted on the future of CNQ. I mean, it's very rare that you can get to buy a Canadian premium oil company at a discounted price. I mean, you're getting premium assets with lower decline, lower leading cost structure, and one of the best management teams in the world. With regards to the red, I'm not exactly sure what metrics you're seeing that are red. I mean, so revenues are slightly down year over year. That's just a function of oil prices being down. But on a long-term basis, I mean, they've done consistently good acquisitions at amazing prices that are accretive to earnings. So they're just digesting now the purchase of Chevron assets that they bought. They've consistently been strong at paying back their shareholders, whether it's through buybacks or dividend increases. They are currently, I believe, giving back 60% of their free cash flow in terms of buybacks and dividend increases. They've already increased their dividend once this year, twice last year. I mean, this is a very strong company. They're going to be able to operate in any kind of oil price environment. And we like their mix of 60-40 gas to oil ratio. And we think that this is a name that's going to do well in the longer term.
So definitely a hold for you.
A buy.
A buy. Got it. Okay. Let's go to the phones. Rob's on the line. He's calling from Calgary today. Hi, Rob.
Hi. Thanks for taking my call. I'd like to hear Rebecca's opinion on freehold royalties. Do you think there's some upside from here, or would you prefer another player in the space, such as a Prairie Sky? Thanks again, and have a good afternoon.
Thank you.
Yeah, it's a good question. We own freehold royalties in our portfolio. We don't think it's a name that's going to double this year, but we like it. It has a consistent 8.3% dividend yield. They are a royalty player, so they don't have the same commodity exposure that some of the oil producers do. They own land. They've been recently doing acquisitions in the U.S. I believe their growth is going to be going forward in the U.S. As well. So we could see some incremental acquisitions, smaller acquisitions from them, but it's most likely going to be in the U.S. We think it's a great risk reward, so you may get some capital appreciation, but at the same time, we're happy to own it and collect that 8.3% dividend, quarter after quarter on a consistent basis with some capital appreciation, in the longer term.
It did drop sort of end of February and then started to climb back up early March. Any reason for that dip, or was that just sort of taken down by everything else that was going down at the time?
So everything else, and also, I mean, even though it doesn't have that commodity price exposure, it is in the oil space. So if there is negative sentiment with regards to energy prices, it could get impacted. But in terms of their earnings and their dividend, their dividend payout, that shouldn't be impacted with drastically with regard. Then they don't have to spend on that E&P like that exploration costs that other producers have.
Got it. Okay, let's go back to the phone lines. We have Mike on the line from Sarnia in Ontario. Hi, Mike. What's your question today?
Yeah, good afternoon. In the vernacular of consistent dividends, would you be a buyer of Bell Canada, assuming they're going to cut their dividend at least in half? And would you consider a range of 27 to 30 to be a possibility in the event that happens? Thanks for taking my call. Have a great day.
Okay, so BCE, we should remind people, is the parent company of both CTV National News, BNN Bloomberg, under the Bell Media umbrella. A lot of questions lately because the stock sank, and a lot of questions about the dividend.
Yeah, it's probably the most common question I receive. Again, we own Bell. It was probably our worst performer last year. It was doing a little bit better this year, but then again, it's come off again. So dividend is about 12.2% right now. There's talks about it being cut. If you asked me a year ago if I thought they were going to cut their dividend, I would have probably said, 10 to 20% chance that they do. If you ask me that same question today, I would say there's probably a greater than 50% chance. But, who knows? I haven't really heard speculation one way or the other. I do think if they cut their dividend, the stock price would probably go up. I think that institutional investors want that dividend cut. It's the retail investors, like our clients, that want that dividend. But most likely the institutional investors have the louder voice with regards to...
There's been a lot of pressure, right?
With a lot of pressure. Absolutely. It's unfortunate what happened to BCE as well as all the telcos last year. I mean, so first we had a run up in interest rates, so that didn't help their debt levels. We had a bad year for telcos with regards to the pricing environment that's been extra competitive. And then you have slowing immigration targets. So, all of those three things combined, one after the other, really caused the telcos to suffer. BCE in particular has, larger capex spend, or they're a little bit more behind Telus with regards to their fiber to the home build out, with regards to the copper decommissioning that's coming next. So a little bit more behind. I think if you have a very long time horizon, I think you can do well with Bell. At the end of the day, we do like the defensiveness of the names. We do like the critical infrastructure that they provide. Telus announced a few weeks ago that they are looking at the potential of possibly selling a minority stake in their towers.
Yes.
If Bell decides to do the same thing, I mean, if they do that, they don't necessarily need to cut the dividend. Whether they do or not, I'm not sure.
Do you think that'll be successful? Because I understand they do that south of the border. Is that sort of a new thing to do here?
They've never done it here. They've been doing it south of the border for a long time, and it seems to have worked. It's a way to free up capital and pay off debt, and then alleviate some pressure on the balance sheet. Maybe they won't cut their dividend if they don't need to. But also with Bell, they also have other levers they can pull, so they can sell some of their Bell media if they want to. They still have some sports, that they can sell, real estate. So they do have a lot of levers they can pull. What they'll do, I'm not sure. And whether a dividend is part of that, I'm not sure. But I do think that maybe we've reached a bottom from here. And I do think that there is potential for the stock to do better.
Got it. Okay, we will leave it there and move on to Jim, who's calling from Elliott Lake in Ontario. Hi, Jim. What's your question for Rebecca today?
Good afternoon, ladies. Rebecca, I've been looking at Barrick Gold here. It's had a nice little run, sort of year to date in 1 year. It doesn't pay the highest of dividends, just a little over 2%. Your thoughts on it, or possibly any other stock in the gold sector there?
Okay, let's talk about Barrick Gold. Gold, of course, has had a great run up, bouncing over 3,000, 3,100. What's your take on Barrick at this point?
Yeah, so Barrick is not a name that we own. They've done, recently, or not so recent, but they've done a lot of M&As. They're still digesting that. Their mines are located in what we would call higher geopolitical, risky environments. So, Tanzania, Chile, Argentina. It's had a good run because, as you mentioned, gold has had a good run. We're looking at all-time highs. Gold is at over $1,300 an ounce in U.S. dollars. The one gold name we do own is Agnico Eagle Mines. We do appreciate the fact that most of their mines are located in Canada. I believe about 90% in Canada, and the rest are still in more positive geopolitical environments. They've been a strong management team, better allocators of capital. Stock has done really well, so it's been a hard entry point for new clients.
Absolutely.
Again, that's just a function of gold prices moving as high as they have. And again, that's also a function of just that flight to safety. Everyone, central banks are stocking up on gold bullion. It's driving the oil prices higher. And then as a result, that's a positive impact on some of the senior gold producers. So again, the only gold producer we own and like is Agnico Eagle because of the lower geopolitical risk with regards to the mines. But again, hard to buy right now. So I would say if you own it, continue to hold it, but maybe wait for a little bit of a better entry point before getting in.
Yeah. I don't know how much of a better entry point there would be. It seems to be hovering still quite high, but you're saying wait for some kind of dip.
Yeah, I mean it's done. It's almost doubled from last year, and so it's just hard to buy at these levels. I mean, can gold prices go higher? Who knows? I mean, but again, we just try to look at good valuations when we're looking at entry points for our clients.
Got it. Okay, we're going to take a quick break. Back with Rebecca Teltscher, portfolio manager at Newhaven Asset Management. Your questions today on Canadian dividend stocks. Stay tuned.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back. Thanks again for joining us here on Market Call. We have Rebecca at the desk ready to answer your questions. We're going to the phone lines. John is on the line today from London, Ontario. Hi, John.
Hi, Marella. Hello, Rebecca.
Hi.
Rebecca, owing to your meticulous nature, I want you to answer this question if you could. The Canadian Natural Resources is to the energy sector as Bank X is to the Canadian banking sector. And I know that you're going to consider dividends, dividend growth, capital appreciation, and then things like the effects of tariffs and economic slowdown. Thanks very much.
I feel like I'm in an episode of Jeopardy. What is?
You know what? I cannot say definitively that there is, because, one of the reasons for CNQ is their low cost and their strong management team. And I just, and the thing with the Canadian banks is their management team, particularly in the past few years, we've seen a lot of change in their management team and their CEOs. And so I don't think there's one management team that stands out as significantly better than the others. I mean, the banks in Canada in general, they're an oligopoly, and they're still a good business to own in the long term. But I think a lot of that growth that they've had in the past 10 years is behind them. Like, we've seen a lot of consolidation in the space, a lot of acquisitions, whether it's small or big. So at this point, in terms of future growth, we're looking at economic growth, which is a little bit uncertain right now in Canada and with tariffs. And we're looking at, cost-cutting measures, like how good are the banks going to do at reducing, overhead to increase margins. So that being said, RBC, I think, is your standard. I mean, if you can own, RBC 50 years ago and then that be the only name in your portfolio, I think you would be doing
okay. Yes.
You'd be doing quite well. That being said, you're paying a premium valuation to own a premium asset. So, if we see that name come off a little bit, then I think there'd be a good opportunity to buy. But because it's a premium asset, it's come off less than the others. Yes. The other one I would say would be, TD. I think it had, and that's more of a long-term hold. We know it had issues, AML issues in the U.S. last year. Growth is probably capped, in the U.S. Uncertain what they're going to be doing there. But I think in terms of their Canadian presence, they have a strong Canadian branch presence. And, even with the AML issues, they've done a good job of just having good, consistent earnings and growth in their Canadian banking divisions.
So do you feel they've come back well from what happened in the U.S., the penalty they had to pay, and then they sold their Schwab interest there?
So again, selling their Schwab, I think, was a good move. It wasn't really a core asset for them. I think, again, it's still early stages in terms of, we still have yet to see the transition of the new management team. I still think that there's going to be more costs involved as they add, into the workforce with regards to more compliance and risk assessment. But I think on a long-term basis, if you can get premium assets at a discounted price, so last year, I think the stock, at $70-something was a really good buy. It's done well this year, but maybe, I think there could be an opportunity for them to go a little bit further.
So even at mid-80s, you'd still buy in?
Yep.
Okay.
Yep.
Got it. Let's go back to the phones. Paul's on the line from Montreal today. Paul, what's your question today for Rebecca?
Yes, tourmaline oil. At the point where it is, how does she see it, and anything with the terrorist situation?
Yes. So tourmaline oil, I mean, we like the name. We don't own it. If we could own an extra, we have a more concentrated portfolio, but if we could own an extra, gas producer, that would be the name we would own. Largest producer, the low-cost producer in Canada. Gas prices were under pressure. They've done well lately. I mean, at the end of the day, I think we need to see what's happening with egress and natural gas in Canada. So, with LNG Canada ramping up, we have some, Pembina, AltaGas working on some projects to export, natural gas or propane off the coasts of BC. So I think that could do well for natural gas prices and natural gas production. The one we own is ARC Resources, and we just think that there's a little bit more embedded growth naturally into the names just by the assets that they own. They have a little bit more wet gas. So a little bit more linked to condensate and oil prices, but we also just like the assets that they own a little bit better than Tourmaline. But I think both names are going to do well in the long term.
Let me ask you about U.S. exposure, because energy could be part of this round of tariffs. We're not really sure yet. Do they have exposure to the U.S. that you're concerned about?
So they do have exposure to the U.S. Again, the whole 10% tariff on energy. I mean, the fact that it was initially announced at 10% and not 25% just shows how the United States is dependent on our oil and gas. I mean, more so oil than gas. I mean, gas we're working on export to Asian markets, so I think that alleviates some of it. But it's all concerned. That being said, even with the 10% tariffs, I mean, the move that we've seen in the Canadian dollar since the tariffs were announced kind of alleviate that extra price impact that we would see. So we're still confident on oil and natural gas sectors in Canada, despite the risk of tariffs.
Got it. Okay, we are going to take another quick break. We want to come back with the past picks from Rebecca, so we'll stay tuned for that. We're back in a moment. Welcome back. Time now for past picks. These are Rebecca's picks from February 5th, 2024, so a little over a year ago. At the time, Rebecca, you recommended a CAE, which is an aviation training company, and at the time it was $26.45. It's done really well. It's gone up to $35.18, so a 33% return, a 33% total return as well. What have they been able to do over the past year?
I love when management gets credit for doing exactly what they said they're going to do. I mean, so the issue that was impacting CAE, so they have two sides. The civil side, passenger aircraft, they do the training for that. That has been good. I mean, it's very well known there's a pilot shortage. As they hire new pilots, they're going to need new training. So that's a consistent growth driver. The other side is the defense side. They inherited, when they did an acquisition, some legacy defense contracts that had poor earnings. They said that they were going to increase those earnings, and I think the market got a little bit impatient, so the stock came off. They've since been able to double those margins, so I think from about 4% to above 8% was the latest. I think it doesn't hurt with the fact that there's so much geopolitical risk right now that doesn't hurt to have an extra maybe exposure to some companies that have defense in there as well. But essentially, good earnings because management has been, performing and increasing margins where they said they were going to.
And their defensive side is also training, or is it hardware? What is that defensive side?
Simulated pilot training. It's also
simulator. Mm-hmm. Okay, got it. So you're in that defense portfolio without being directly sort of producing weapons, manufacturing planes, that kind of thing.
Yeah, exactly. Just flight simulation. And again, a very small part of the overall business. So it was when the stock came off as much as it did because of their defense earnings, it was you could tell it was overdone because it's just a small part. And at the time when I recommended it at $24, I mean, you were not even paying for any of the defense. You were just getting that business for free. It was, we owned it really for the civil side, and the defense, was a bonus. But now, both sides seem to be doing well.
Got it. Okay, let's get to your next pick from February of 2024. Emera, at the time, $47.67, also done very well, up to $60.78. They are an energy services provider. What has been going on with Emera since last year?
Again, utilities just doing what they say they're going to do. I mean, this is your stable name. It was very much discarded in the market a year ago. Everyone was chasing AI and the latest tech trend, and no one cared about your boring, stable utility that was, had a 7% yield at the time, that was just doing steady growth. And here we are. Now we're in a different environment. I mean, you see that run up. That's really just from January of this year, as the markets are a little bit spooked about the economy, spooked about about the U.S., and now they're looking for a safer trade. Two particular things that happened to Emera that also helped the stock price was S&P upgraded their outlook from negative to stable. They've done a good job of reducing their leverage in the past year, I would say. And then also their largest jurisdiction is in Florida, and they were hit by two back-to-back hurricanes in the 2024 season, and they've now been able, like the Florida regulatory body just approved storm reparation costs that they're able to pass through to the customers. Again, that was expected. Florida is a pretty good jurisdiction to operate in, but again, utility space, they've all done pretty well this year, and it's nice to see that the defensive characteristics are now paying off in the market and is now attractive to the market.
Got it. Okay, let's get to your third pick, which is BIPUN, so Brookfield Infrastructure Partners, which was at 42.03, has gone up to 42.94 since last February. So a 2% return, but 9% total return when you have a dividend in there. They have operations North, South America, Australia, even Europe.
Yeah, so this one, is I'm scratching my head as to why it hasn't performed as well as some of the other utilities in the space. It just kind of seems to be tracking around the same, $40+ level, and it just can't seem to break free. And I'm not sure why, because they're doing everything they said they're going to do. I mean, we like this name. It's basically yield plus growth. So you're getting about 5 to 6% dividend yield, but they're able to also have some organic growth. They are what they call serial, like they're capital recyclers, so they buy assets at very discounted prices, ones that no one wants. They own it, they operate it, they extract value, and then they sell it. So, because they're not that buy and own strategy, which is, let's just say, the safer strategy, maybe the market is questioning whether they have the ability to continue to sell at premium prices, but they keep executing. They keep doing what they say they're going to do. I mean, they just did a transaction. They sold it at a very good multiple. We like the ability that this is a chance that we can own the infrastructure that we like. So toll roads, airports, energy infrastructure, utilities, data centers. These are all stable infrastructure that we like, and we're able to own it through different jurisdictions. So as you mentioned, like internationally, which is a nice differentiator from the traditional Emera and Fortis that has just Canada, US, and just utility distribution assets. You get a lot more diversification and a very strong management team as well.
Okay, we do have to take a quick break and line up some more phone calls for Rebecca. We'll be back in a moment. Stay tuned. Thanks for joining us on Market Call. We're going right back to your phone calls. David is on the line. He has a call. He's in Ottawa. Hi, David.
Yes, hi. Thank you for taking my call. My question is on Enbridge. And Enbridge for the past few weeks has been doing very nicely. My question is whether or not people have priced in the expectations of tariffs and the fact that it's only going to be 10% tariffs for the energy sector. And so people are not as worried about stocks in the pipeline sector. Another question is, do you own Enbridge, and do you own it for yourself and for your clients? Thank you very much. Have a great day.
So we touched on this a little bit about what kind of exposure there is, and the fact that it's a 10% tariff. People seem to think that it's not really going to be hit hard because it's only 10% and can be absorbed more easily.
Yeah, I think, I even have trouble understanding it. And, my partner, Ryan Bushell, he's the energy expert. But, I don't think the average person really understands just how embedded North American energy infrastructure is. And so, a lot of the oil that's coming from Canada into the United States cannot just easily be replaced. Even if the United States does produce a lot of oil itself, depending on where it needs to go, where it needs to be refined, what kind of grade oil, whether it's heavy oil, lighter oil, and what kind of the refinery can take. These are not just like
simple switches.
Yeah, exactly. So with regards to Enbridge, they're the largest oil pipeline operator in Canada. There's, pipelines are still the cheapest way and the fastest way to transport oil. I mean, they're trading cheaper than rails. And it's cheaper to transport oil via pipeline than via rails. And so, at a 6% dividend yield, we do own it. I own it personally. We own it for our clients, and we're going to continue to own it. With regards to tariffs, as I kind of mentioned before, so first, from what I understand at least, I don't believe the pipelines itself are going to be hit by tariffs in terms of the tolling arrangements or the contracts with regards to the transportation of the oil.
Static.
Right. But with regards to the oil prices, I mean, we've already seen quite a drastic move with regards to the Canadian dollar that would mitigate the impact of that 10% tariff of oil coming into the United States. And even if not, I do think that the United States is still dependent on that Canadian oil coming through that Enbridge pipeline. So I don't see any of that volume being disrupted.
Got it. Okay, let's go back to the phone line. Scott's calling from Nanaimo, BC. Hi, Scott.
Hey, good morning. Yes, I'm a longtime viewer, first-time caller, probably a couple of decades viewing now. And Rebecca, I really appreciate your passion for the dividend sector and your clarity of your analysis. A number of months ago, you mentioned just in passing about Algonquin Power. I've made a good return on Algonquin for kicking off the bounce off the bottom. I'm just wondering about your thoughts of it going ahead in these uncertain times ahead of us. So appreciate your analysis. I'll hang up. Thanks.
Thank you.
Great. Well, I'm honored to be your first-time caller. I appreciate it. And congratulations on being one of the few people who've actually made money on Algonquin. Okay, sorry, bad joke. We own it. We've owned it for a while, so obviously, it hasn't done well on a long-term basis. Obviously, this year it has bounced off the bottom, and it's actually one of the best-performing utilities just because it's been trading so low for a while. We are dividend investors. They had 2 dividend cuts. I don't want to say they made mistakes. I think they did an unfortunate acquisition, or they tried to do an acquisition at unfortunately the wrong time, just as interest rates were going up. It was that Kentucky Power acquisition. They then, decided not to go through with that acquisition, but they just got penalized by the market. I think a lot of investors got out of the name. They don't want to go back into the name just because there's been, a lot of issues. And but really, now if you look at it from today, they are really working on transforming themselves to a pure play utility. So they have sold their renewables assets. They still have the hydro assets, but it's a small to their overall. They sold the renewables. So they're really looking at a pure play distribution utility. So similar to an Emera, similar to a Fortis. They operate in Canada and in the United States. They have many different jurisdictions, which we like the diversity of the jurisdictions that they operate in. I believe like right now they have about 10 to 20 different rate cases that are currently under review. So as we see those rate cases get filed and approved, we'll see some uptick in terms of their how much they're willing to earn on their assets, which is a positive. They have a new CEO in place. They do have an activist investor, I believe, Starboard, and they are supportive of them transitioning to a pure play utility. So, I believe all the negative news is out of the name. I think if you have the patience from here, this is still the cheapest utility to own. It's the cheapest assets you can own, these pure play distribution utilities in the market. So I think there's only upside from here. I think as the company keeps performing and doing what they say they're going to do, we're going to see that investor sentiment tick back into the name because it's a different company than it was 2 years ago.
Okay, got down to about $4.27, I guess, at the start of the year before, as you said, bouncing back.
$4.20. I don't believe it went
let me look.
low. Maybe in U.S. dollars. I'm not sure.
Maybe. Yeah. Sorry, I'm looking in U.S. dollars. You're right. And now can I take a look back at that chart? I just want to see where it bounced back up to today. We're going to pull that back up. That's Algonquin Power.
I believe it's $7.5.
So $7.41. Yes, you're right. Okay. On that note, we're going to take a quick break. We're going to line up more of your phone calls for Rebecca in a moment. Stay tuned. Welcome back to Market Call. We're going right to your phone calls. Tony has been holding on the line, and he's calling from Topsail, Newfoundland. Hi, Tony.
Hi. Rebecca, I currently hold Teltscher and have it on drip. I hold it because of diversification and the dividend. interested in potentially adding to the position for long-term hold and for income. Your thoughts? Thank you.
Telecommunications in a bit of a harder spot.
Yep, but you know what? For those reasons that you said you want to own it, those are the reasons that we own it too. One, it's a long-term hold, and two, for the income. So, we're never going to sit there and say, TELUS is TELUS and BCE are, high growth stocks. These are lower growth, stable, defensive names. They own critical infrastructure. They perform well, usually during recessionary periods. We like them. TELUS, out of the bunch, is probably in the best position relative to the other telcos. They're further along with their fiber to the home build out. They're in the process of, trying to get that fiber decommissioning. So they're in a better financial position. They're probably also in a position where they can have a little bit more growth ahead of them. But when we're talking growth, we're talking, 2% versus 1%. So again, slow growth, but you know what? 7% dividend. They do about 2 dividend increases a year. I think they're mentioning that they're going to continue to grow their dividend. So, for those reasons alone, when we give return expectations to our client, we try to be very conservative. We say 5 to 7% a year. Historically, I know the markets have done more the past few years, but the markets have really been on a tear the past few years. So let's just be a little bit more conservative, 5 to 7%. If we can get as much as we can in the form of a dividend, then you're not relying as much on the stock price. With TELUS, you're getting that 7% dividend with regards to upfront right away. So even if the stock price, goes down on a current year, then goes up again, you're not using that money to, sell down to fund your lifestyle. You're living off of that 7% dividend income. So we can allow that stock price to fluctuate, even if it gets a little bit weaker. But I do think it's a good entry point from here.
Got it. Okay, let's go back to the phone line. Sal is on the line from Toronto. Hi, Sal.
Hi there. Yeah, my question is on BRP. It's been in the news recently. It's been taking a hit this entire year so far. I was wondering, based on the earnings that happened just now, do you think this is a good time to get into this name, or is it better to wait it out? Thanks so much.
So they've sold off part of what they'd owned, and part of that is being bought up, I guess, in Australia.
Yeah, so, I'm going to talk about this in a more general way. So, at the end of the day, their underlying business is very discretionary. They do like the ski-doos and recreational sales. So not only have they underperformed this year, but last year too, I think the stock was down 23% last year. It's down another 24% this year. And this is why we try to stay away from any kind of discretionary name. So, this is not a name we would own at any point in the cycle, just because it could be so volatile. We are now entering a period where the consumers are a little bit more strapped. We don't know what's going to happen with the economy. The Canadian economy is for sure weaker. The U.S. economy is weakening. And so the first thing that people cut are these types of products, these discretionary items that are, recreational in nature. We've seen, I think BRP in particular, they have high inventory from lower sales, so then they're going to have to do some significant pricing promotions and discounts, which means lower margins overall. So, if you want to be cute and time it and buy it, now maybe, but at the end of the day, you're going to have to constantly keep your eye on this thing because it is so cyclical in nature. And this is why we just as a long-term investors, we try to own stocks that you can own through an entire market cycle. This is a name you would want to really own during an up market cycle, which we are clearly not in right now.
Got it. Okay, let's get one more caller in. Sam's calling from Toronto. Hi, Sam.
Hi, thanks for taking my call. My question is just generally on portfolio construction. I've done well with a pretty aggressive portfolio, but I'm now entering a different stage of life where conservative dividend-producing investments would be best for me. And I'm under constant worry with Trump tariffs and uncertainty and just the chaos that he's bringing to the markets. How long would you take to layer in a significant amount of cash if you say needed it in 3 years? Thanks in advance, and I'll hang up and listen to your answer.
Well, first, welcome to the world of dividends. We are investing in dividends, for clients at any point of their cycle, but we understand the need for current income as you're entering the next phase of your life and inching towards retirement and wanting some more stability. So, it's a valid question. I would say, a year ago, we were earning on our money market fund, that we just kind of plug in for uninvested cash, we were earning 4.8%. That's not negligible. And it allowed us to have that patience that if we wanted to ease into the market, and especially, there was a real disconnect last year with regards to what the economy was doing and what the markets were doing, that disconnect seems to be coming, back a little bit. So, we're seeing markets a little bit weaker. They're not just on this like risk-on trajectory where, any economic print in the market still continues higher. Like, we're not seeing that anymore. We're seeing more volatility, which is a good thing if you're looking to deploy some cash. But the main factor is your yield on cash has come down significantly in the past year, specifically in Canada, as we've seen many the Bank of Canada drop rates a few times. So now we're earning about 2.5% on cash as opposed to 4.8. So, 2.5% isn't enough to live on. So if I'm looking, our portfolio has a dividend yield of about 4.5%. So if I can earn 4.5% dividend yield versus 2.5% on cash, I'm more likely to want to deploy into high dividend, earning stocks. That being said, could we see some more volatility in the market? Absolutely. If you have a long-term time horizon, those impacts mitigate. I would probably, get a third in now, and wait and see, on days where the market's taking a beating, buy more and look at selectively. I mean, I think, the pipeline space, for example, you're still getting about 6% dividend yield and they've done well, but they haven't, doubled. So I think there's still some good opportunity. Telus was another one that we noticed. So I think there's still good opportunities for some yield, and you're not paying crazy valuations for it. And especially if you're, looking to take some risk off, I bet you're selling some of those tech names at crazy valuations at like 30, 40, 50 times earnings. And to be buying a utility at 20 times earnings doesn't seem so expensive on a relative basis.
Got it. Okay, we do have to leave it there for phone calls and questions. But don't go away because Rebecca is going to share her top picks. That's coming up. It is time now for top picks. So Rebecca's at the desk and she's going to walk us through those. Your first pick is Aecon on the TSX, which is construction, of course, very well-known name. Why do you like them moving forward?
Oh, I mean, so first, the stock did really well last year, and it's come off about almost 40% year to date. So I think there's a real opportunity now to get in. Half of their construction projects are linked to utilities, which again is a sector that we like. So utilities are power. They do a lot of the nuclear construction, nuclear refurbishments, and ongoing maintenance. So very safe in terms of their projects, so not as discretionary. And then, the other thing too is you just look at, the announcements the governments are making. Ontario just announced that they're exploring the potential for a new large nuclear facility. The Quebec just came out with their budget, and it's increasing infrastructure spending by 7% over the next 10 years. So all of this really good opportunities for, public and private spending, going forward. The stock's down, never cut the dividend at the bottom. You're getting a 4.5% yield to own it now. I think it's a good buy.
Why has the stock been driven down?
I think it went up too much in the first place, and then I think concerns about the economy. But like I said, the underlying projects are pretty conservative in nature, a lot of transit exposure. Whether we're in a recession or not, I don't think that the government is going to stop spending on transit projects like, Metrolinx and the LRT.
Got it. Okay, let's get to your next topic, which is premium brands, also the TSX as PBH. What do you like about premium brands?
So this is a new position that we just initiated for all our clients earlier this year. It's a consumer staple. They have two main segments, specialty food, so that's retail, and they have their food distribution. So think that they distribute food to hospitals, schools, restaurants. But, their main segment is their specialty food. So, I'm a working mom. My husband works as well. The two factors that we look at is, food transparency and convenience. I don't have time. I'm not at home every day to be able to cook, 3 meals a day. Mm-hmm. And so I'm looking for healthier food options, ready-made food options. So, premium brands, they do, think about cooked meats, cooked meat, the chicken that you could put in your salad,
just grab and
kebabs,
and move on. Yep.
Sausages, things like that. They're in all stores. They have, they operate under, let's just say, 60 different banners. So no, brand risk. It's not like they have a flashy brand like a Maple Leaf Food, where if there's something
there's
goes wrong,
a problem, right?
Right. So very discreet name brand. But I think the main thing is that they're under a huge growth trajectory right now that is discounted by the market. So in the past few years, they've been spending a lot of money to increase their U.S. distribution. That's going to do two things. They're going to be able to take on large brands. So right now, one of their largest customers in Canada is Costco. They're going to be able to do nationwide products on Costco U.S., but they need to build that facility. So they have so much demand for their product, just not enough capacity. They've been working on building their capacity in the U.S.
Okay.
And also the cross-border through the tariffs with their U.S. acquisitions and U.S. build. They're going to be able to change the distribution so that they don't have as much exposure to tariffs. Their total exposure is less than 5% anyways, but they're working to mitigate that even further.
Got it. I do want to get into your last pick here because we've got about a minute. AltaGas is your third pick.
So AltaGas, again, historically was discounted by the market. They're half utilities, half gas processing. People were like, if you want to own a utility, just own Fortis. If you want to own gas processing, just own Pembina. We like it for both. Now both seem to be doing well. Their utilities growing 8% rate-based growth, which is higher than other utilities in the space. Their gas processing, they're working on huge LPG, so their propane exports off the West Coast are their large projects right now. If you think about this whole tariff situation in the United States, a lot of producers, like that produce gas, like Arc Energy, they're looking for capacity outside of the United States. So if you're able to link yourselves to a project that's exporting propane off to the Asian markets that have higher pricing, and you're limiting exposure to just exporting yourselves to the United States, again, AltaGas has two LPG export facilities to be able to export to Asian markets.
Got it. Rebecca, we've got to leave it there. Rebecca Teltscher, thank you very much for joining us.
Thank you so much.
The viewers appreciated your good advice today. Thanks for that. And as we go, let's take a look at the markets. We'll see you again on Market Call tomorrow.